Dividend reinvestment plans, often called DRIPs, are one of the simplest yet most powerful ways UK investors can grow their wealth over time, especially if they are investing for the long term. So let's explain how they work in plain English. Normally, when you invest in shares or funds that pay dividends, you receive those dividends as cash in your account, which you can either spend or reinvest manually, but with a DRIP. Those dividends are automatically used to buy more shares of the same investment instead of being paid out to you in cash. This means that every time a dividend is paid, your money goes straight back to work without you having to do anything, allowing you to benefit from compounding, which is essentially earning returns on your returns. For example, if you own shares in a UK company or a dividend-paying fund inside a stocks and shares ISA and it pays a dividend, a DRIP will use that dividend to buy additional shares, even if it's just a fraction of a share, and over time, these small additions can add up significantly. One major benefit of DRIPs for UK investors is that they encourage disciplined investing because you're reinvesting automatically rather than trying to time the market or deciding when to buy more shares. And this consistency can really boost long-term results. Another big advantage is tax efficiency, especially when DRIPs are used inside tax wrappers, like a stocks and shares ISI or ASIPP, where dividends and capital gains are completely tax-free, meaning all your reinvested dividends can grow without being reduced by taxes. Outside of ISAs, dividends may be subject to dividend tax once you cross the dividend allowance, which is why many UK investors prefer to use DRIPs within tax-efficient accounts. DRIPs are particularly popular with long-term investors who are focused on wealth building rather than short-term income, such as people saving for retirement or future financial independence, because instead of living off dividends now, they are using them to grow their investment pot faster. However, it's also important to understand the risks and limitations because DRIPs do not remove market risk. If the value of the investment goes down, the new shares bought through reinvested dividends can also fall in value, especially in the short term. Additionally, by reinvesting dividends into the same company or fund, you may become less diversified over time unless your investment itself is already well diversified, like an index fund or ETF. Some platforms in the UK offer built-in dividend reinvestment options, while others require you to manually enable it or reinvest dividends yourself. So it's always worth checking how your broker handles dividend payments and whether there are any small dealing fees involved. In simple terms, DRIPs are not about getting rich quickly. They are about patience, consistency, and letting time do the heavy lifting.